This is a stock market bubble, and a 42-year-old one. I don't think that people realize that the stock market, the S&P 500, is up 43% over the last year. Can you imagine the stock market going up 43% in just a year? 90% over the past 5 years. That's something mind-blowing, but considered normal these days. I'm going to give you something even more mind-blowing. I went to the data specialist Yardeni Research and just look at the S&P 500 bull markets since 1928. The percentage gains there: 70, 46, 100, 120, 37, 90, 38, 60, 20, 20, 60, 70, 20, okay, 1, 267, 80, 70. These were the bull markets, and then you had also the bear markets in between. However, look at the last 40 years. 200, 500, 100, 400, and then again 114. And this all means that we are in a bull market since 1980. If I look at the historical stock market, let's take out the inflation adjusted, and you can see here the log scale. So 1982, the stock market was around 107, and since then it just went up. This is almost 60 times, including dividends. That's more than 60 times in 42 years on two staggering bull runs. First, the big run, the 1980s, 1990s, till the dot-com bubble, a small deflation, great financial crisis, more money printing, more debt, and we are now at almost a 10x from the bottom in the 2009 period. This is the greatest bull market in history, and a 44-year-old bull market without the normality of the stock market that was in the past. This is something spectacular. And if I look at the returns from 1982 till now, the returns 10% from stocks plus the dividend, 12% yearly returns over 42 years, something staggering. If I go to the previous cycle, let's say the peak, a little bit more, still good, 8%, and a more normal 10, 11%. But 44 years of stocks just going up. What are the drivers of these returns? The current P ratio is 30, but the mean historical is around half of that. And this is the S&P 500 P ratio now at 30. Great run up over the last 2 years as the market doubled. The P ratio went up, nothing else. But look at this, the P ratio was 7 in 79. Here, 7, 8. 8, now it's 30. What's that? Almost a 4x in valuation. And the P ratio is now much higher levels than it was during the boom, the bubble of the 60s, the Nifty 50 bubble. During 1929, much higher. We are now at great new territories at a completely new cycle. But keep in mind, the average is half of where we are now. And the P ratio can get extremely low if things change. Because if I look at current earnings, those haven't been really growing over the last few years, no matter what Wall Street says. Let's say 200, P ratio 30, we are at 6,000 points. If I put a normal historical P ratio of 15, that's normality, what happens to the S&P 500? 3,000 points. So half of the returns in the market are just from an expansion of valuation. We could even say 3/4 of the 40-year bull market are an expansion in valuation because the P ratio went from 8 to 30. 3/4 of the stock market, it's just thanks to valuation. And if you're investing now in stocks, you have to understand that. Plus, we can discuss cycles a little bit if you care about that. Look at this. Since the bull market started, interest rates have been going nothing but down. From almost 20% to zero. and now everything is priced like interest rates will go down again to 2%, inflation 4%, and the party will continue forever. That's the projection of the Fed, to lower rates, to make it easy for all the huge debt borrowing that doubled after the financial debt crisis. Debt to GDP skyrocketing. We are borrowing like there is no tomorrow. Plenty of money, exuberance, whatever. And then, as they say, this time is different. I just typed this time is different. And there is a great book from 2011 called This Time is Different that explains 8 centuries of financial folly. This is financial folly. The last time was subprime crisis, borrowing, whatever. You might want to believe it or not. Let me show you just another chart. So I've shown you this huge run-up. Let me just eliminate the log scale, and this looks even more frightening on how much the market exploded just in the last 15 years compared to the past. This is one leg up. Second leg up. If you think there will be more legs up, well, good luck. And this is a great comment here. So I've been listening to this for 10 years, no crash. Well, the market doesn't have to crash. This is just the risks. It might go on. I hope, I beg it goes on forever, because the alternative is not good. And even Goldman Sachs projects the market to continue growing next year 10%, even if they warn of an ongoing lost decade for investors with just 3% per year over the next 10 years. -1 to +7 is their scenarios, average 3. If we go to GMO, the returns, real returns for US stocks are terrible, 5% down per year, -50% on any kind of fundamental logic. If this cycle reverts, and we have enjoying 40 years, if it goes to this, as it was the case in the 70s, right, 75% down for stocks in real terms, as it was the case in the 70s. Thanks for watching, I'm out, I'll see you in the next video.